It is now my turn to provide comments on these two papers. So I think this is a wonderful session, and in the unintended effects of oversight. What my goal is to first have some overarching comments about both papers combined, and then I'll dive in a little bit deeper into the two papers, but recognize I only have 12 minutes in total, so it will not be a very detailed discussion. I try to keep the comments a bit more high level. So it is very well recognized that even absent government safety nets, that government regulation of banks may be necessary. And it is also well known that safety nets themselves and resulting distortions in bank behavior actually increase this need. Now, an important issue, and you saw it in both papers, is that regulation often has unintended consequences. And the unintended consequences may actually be so big that it actually hurts the original cause substantially. Here, I just give one example, but I could give many different examples of indeed papers that document this. So here's a paper by Huang and Thakor, which documents that state-chartered banks, that they consider the political inclinations of the party in power when setting their capital ratios and also when deciding on their lending practices, including their CRA compliance. Now, both papers in this session address this issue, but do so in very different contexts. The research question that both seem to address is, how does bank regulation that is designed to better serve certain disadvantaged borrower groups, how does that affect the behavior of banks and their borrowers? And the answer that comes out very clearly from both papers is that banks respond strategically to regulation, especially threshold-based regulation. And this ends up distorting the behavior of banks, and this may have real effects. And when you then inject the government into the process, this can also distort the behavior of the borrowers. Let me now say a little bit more about the first paper, Strategically Staying Small, Regulatory Avoidance in the CRA, the paper that Carlos presented. So in this paper, the question that is addressed is, how do banks respond to a two-tiered regulation system with the CRA that actually imposes a greater burden on banks above a size threshold? And that paper documents that, well, banks, they act strategically. They manipulate their asset size because they really don't want to cross the size threshold. And this has important consequences because this affects their lending behavior, meaning it increases their rejection of LMI loans. And it also has important real effects because the areas that are served by these banks, they experience a decline in the county level share of small establishments and innovation. This paper very clearly indicates that indeed regulation has unintended and undesirable real effects, and that this actually hurts the groups that the CRA intends to serve. Now, just to put this paper in a broader context, size-based regulations are pervasive in banking. We don't just have the CRA, we also have Dodd-Frank, we have the Basel Accords, we have Truth in Lending, we have the Home Mortgage Disclosure Act. So lots of different settings where thresholds based on size are in place. And let me talk a little bit more about one of my own papers that is cited in this paper, in which we actually focus on the size thresholds that the Dodd-Frank Act initially put in place. So additional regulatory requirements were put in place for banks with assets above 10 billion and 50 billions. In our paper, we also document that Dodd-Frank had important effects on lending behavior. On net, we document that there were regulatory costs that increase across these size thresholds, and that banks that are below the threshold, they grow their assets and loans more slowly to avoid crossing these thresholds. And one way, we did not have a causal effect here, but one observation that was consistent with banks indeed slowing their loan growth is that we find that banks charge significantly greater loan spreads if they're below the thresholds. Now, one thing that is very important to realize when you deal with papers that have size thresholds, and that is like, how do you actually establish the treatment effects? Because a lot of times when you think about treatment effects, you think about a traditional setup where, say, there are patients, so people are sick, and part of the sick patients, they get a particular medicine, and others do not get the medicine. And then you look at the treated versus the non-treated. Well, in this setup with size thresholds, you cannot use that traditional setup because the ones above the size threshold are treated, but the ones below it, you cannot view them as untreated because those are the ones that can engage in strategic behavior. So in the paper that I have in the JFI, we try to solve this by really saying, well, we need to change this setup. Yes, the banks above the $10 billion size threshold are treated, but the ones right below it are indirectly treated. Those are the ones that engage in strategic behavior because they want to potentially stay below the size threshold. And then you need to look for untreated banks further below the size threshold. So in our paper, we ended up with direct treatment effects and indirect treatment effects. This paper that Carlos presented has a different approach, inspired by Bartik 1991. So here, interestingly, they view the banks below the size threshold as treated, even though the true treatment was not for these banks, but it was for the banks above the size threshold. And then they view banks up to 350 million to be untreated. So I think the paper would benefit from a richer discussion about this particular topic, because it's very important. The paper finds that there are residual real effects, which means that truly there were no substitution effects, meaning there's one group that changes their behavior and the other banks, they did not make up for this distortion. So in the end, there are indeed residual real effects. This is an important finding, and it's not always that you find this. There's other papers. Here I just mentioned one that is forthcoming in the JFI, and that paper shows that actually when one group is targeted and changes its behavior, unaffected banks actually adjust their behavior, and the effect is actually muted as a result. Let me now move on and talk about small bank financing and funding hesitancy in a crisis, evidence from the PPP. So this is the paper that Tatjana presented. In this paper, the question that is addressed is, how did subsidized financing under the PPP affect firms and borrowers? And the key results here are that smaller firms were less likely to gain early access to PPP. This effect, interestingly, was not as strong in small banks and also in small firms that had relationships with banks. Now, the second result is that the hesitancy of the small firms to join the PPP program, maybe it's driven by their reluctance to be subjected to greater government oversight. The first result in the paper, so that smaller firms were less likely to gain early access to PPP, but that effect was attenuated in small banks and small firms with relationships, seems very similar, or is at least consistent with a finding in a recent paper that I have with several co-authors, also on the COVID crisis, where we actually document that small banks that they provided their small firm relationship borrowers with financing at better terms than non-relationship borrowers. And that is consistent with theoretical predictions in Boot and Thakor. This is also consistent with other recent evidence that relationship lending has real effects. The second result, that small firms were hesitant to join the PPP program and that might have been driven by their reluctance to be subjected to more government scrutiny, seems consistent with some theories on the interaction between politics and bank lending. So, interesting book by Colomiris and Haber, a paper by Thakor. It also seems consistent with maybe rational expectations. When you look, for example, at TARP and PPP, the government actually ended up changing the rules in both cases after the program started. For example, when you look at TARP, after TARP, the first TARP recipients had received the funds, salaries of senior executives at these firms were capped at $500,000. And the SBA announced, and Tatjana mentioned this, that the SBA actually would audit PPP loans in excess of $2 million. And they might also spot check other loans. So maybe it's indeed rational expectations. We don't know if there will be greater scrutiny, but there may be, and therefore we may not want to apply. Both results also somehow seem to be related to a recent working paper by Berger, Kaplan, and Roman, which focuses on PPP. So in that paper, they very clearly indicate, hey, these firms, they do not apply to the government, but they apply to the banks. So the small firms may be hesitant to apply for a loan simply because they don't have a strong relationship with their bank. Also, one of the key results in the Berger paper is that the banks that have stronger political connections are more likely to get PPP funding. So maybe the small banks have worse connections, and as a result, it's the small banks that end up with less of this type of funding, and as a result, also the small firms that bank with these banks end up with less funding. Okay, I am out of time, so let me conclude by saying these are two excellent papers that examine in two very different contexts that the design of bank regulation really should account for the strategic responses of banks and borrowers and should be very cognizant of the effect that there may be unintended consequences and that bank regulation may actually end up hurting the very groups it seeks to serve. And an important policy implication may be that when there are new regulations, maybe we should view them as experiments and we should be sufficiently flexible that we modify or maybe even eliminate regulations that seem to be counterproductive. Because if we don't do that, we may end up in this vicious cycle where you have regulation, bank response, distortions, more supervision, more bank responses, etc., etc.